This morning, I had a chance to sit down with Goldman Sachs CEO David Solomon, and I began by asking him why, despite the bank's strong performance on every single line, whether it be revenue, earnings, return on equity, the stock is among the lowest when it comes to our key ratio, which is the price to earnings multiple ratio in the S&P. Here's what he told me.
I think people are concerned that the capital markets environment is going to be less robust going forward in 2022, 2023. But we, as we stated last week when I was down in Miami at our investor update, are extremely confident that we can deliver over the next 3 years mid-teens returns for our shareholders. And we're executing on our strategy. And our strategy is working, Jim. I mean, we are focused on clients. We are focused on operating with real excellence, and our strategy is working.
But is it possible that last year was as good as it gets, and even with the strategy working, you cannot replicate what you did in 2021?
Well, I don't think we'll replicate what we did in 2021 and 2022. There are a number of people that said the firm could never earn over a 20% ROE ever again, and we did. I'm not saying we're going to do that next year. In fact, I don't believe we will. But it's a long road, and what we're really focused on for our shareholders is the consistency of returns over time, the durability of returns over time, and compounding our book value. I think book value growth underpins the value of a financial institution like ours, and we've shown over a very long period of time that we can grow our book value on a comparative basis. It's very attractive.
But
relative
1 in
to other
10 years, you've led in book value.
We've led in book value growth.
Underperformed three of the major banks. If your thesis is true, how can that be possible?
I think people, and this is one of the parts of our strategy, we are diversifying our mix. We're adding more asset management revenues, which is in the form of predictable fees. We're adding more wealth management, which is in the form of predictable fees. We're adding a digital consumer business, which basically takes lending book, which adds a predictability level to the overall mix of earnings. Capital markets revenues are hard to predict in every given year, and the market's clearly saying they'd like a more diversified Goldman Sachs, and so we're moving in that direction.
Well, let's talk about some of the capital markets, which many people are concerned about. IPO market, there's only one small deal this week. SPACs, which were really, really lucrative for Goldman Sachs, seem to be dying off. At the same time, Russia, Ukraine, and Fed tightening. Isn't this a mixture that is too hard to be able to, even for the first quarter, say that the consistency is going to be there?
Well, there's no question that equity activity has come down meaningfully. I think if you look at the volumes, as off the top of my head, so don't hold me to it perfectly, equity volumes are down approximately 60%. But M&A volumes are still pretty active. The backlog's still strong. Debt volumes are still relatively active. So I think you have to, when you look, I'd say the activity levels feel better than 2019.
Okay.
But not as good as 2021. And so when you look at our banking business does not have to look like it looked last year to be a very good return contributing, good earnings contributing business. And clients are active because of what you said. There's a lot going on in the world. People are transitioning to a world where inflation is above trend. There's geopolitical risk in the world. And so with that activity comes opportunities for us also to serve our clients.
Is it an opportunity, for instance, that the president announced sanctions on two Russian banks in the 1997 Russian financial crisis? Goldman very much involved, knew everything. These kinds of actions would be enough to start a collapse of the ruble and the stock market. It seems like nothing is happening, and that perhaps this is an opportunity for your clients.
Well, the market the last couple of days appears to be relatively resilient in the context of this news, but I would highlight that it's early. Sanctions, I think, can be an effective tool to contributing to influence or behavior change over time. And so we're watching this very closely, and our clients are watching it very closely, and we'll have to see how this all unfolds.
We have, when I worked at Goldman Sachs, Russian clients that were very wealthy. The president's targeting those. You are client-focused. What are you saying to them?
Well, the particular clients that have been focused aren't clients of Goldman Sachs, to my knowledge. But we'll watch with everybody else. I think it's early, Jim. I think this is the first step in a process. I think the market expected something, and I think they got something on the lighter side of what the market expected. But we'll see how this all unfolds. It's early, and we're watching it closely.